Good afternoon and welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at MarketSite is Ted Bragg. He's the head of U.S. fixed income over at Nasdaq. We're here for a preview in front of the key employment report on Friday and, of course, an update on Nasdaq fixed income. Ted, thank you as always for joining me at MarketSite. Big story has been over the past couple of weeks, the yield curve.
Yeah, it's funny. Last week's paper, even this weekend, everything was about the yield curve. And what are they really talking about? They're talking about 10-year notes right now, 285, and the 2-year note at 254. So 31 basis points, and if the Fed's going to continue to raise rates in the front end, do all of a sudden short rates go higher than long rates? And what that's done in the past is really forecast a recession. But I actually think there's so many other things going on that you can't look at that yet as if it's a precursor to recession. And I'd love to maybe explain a little bit more of that. And part of that's the numbers, right? The economic numbers point to huge strength. We were just talking about GDP at 4% possibly for the second quarter. Payroll number this Friday could be close to 200 again, or somewhere around 188. So strength and strength and strength, which puts a Fed September and December 2 more rate rises. And that's where you get the bump up in the short rates because of those rate rises and really what happens to longer rates.
So let's talk about your second half outlook because you mentioned about the yield curve not necessarily pointing to a recession, economic data with GDP at 4%, and employment numbers at record. It feels as if these are all good things, but there's a lot of unknowns for the back half as well. So do they cancel each other out?
Yeah, so midterm elections, everyone wants to know what's going to happen there and if there's a possible change and change for policy. A lot going on in Europe. Germany, a lot of political turmoil. Same thing with Brexit and the decisions around that. Absolute yield and investing. As I said, 2-year notes at 285, but German, or 10-year notes at 285, German 10-year notes are at 30 basis points. So you have 250 basis points pickup in the U.S. market. So there's massive asset allocations globally that put money into the Treasury market. And then it's a question about inflation. Yeah, we have a 2% number, but the Fed continues to say, don't worry about inflation, don't worry about inflation. The backup in long rates can only happen if we're going to see that type of pickup. I think Goldman Sachs also came out with at the end of last week. We thought 10s were going to go to 3.25. They've now changed their mind and said, not that they're bullish on the market, but they're basically saying they're not going to back up just yet, so kind of cover your short. And then it's where's cash going? If for the last 5 to 10 years you tried to put money in the Treasury market, you really didn't get much of a return. But in the front end, there's been a huge asset allocation out of equities and into T-bills, into 2-year notes. You're getting real yields now into CDs. So that allocation needs to kind of shift its way around. And where cash is going, I think would be much more important to follow right now, knowing we have stronger numbers, than trying to forecast that much bigger future recession.
If you were not familiar with the fixed income market, when we hear the basis point moves in the treasuries, they don't typically move as much as we have seen them, above 3, below 3. Is that a big move, the basis point moves that we've seen?
Yeah, so, well, if you look at it overall percentage perspective, so it actually, the rule of thumb used to be from a high and a low interest rate of the 10-year note within 1 year time frame could be a 100 basis point move historically. So say if we're 285 now, maybe it would have traded 250 and 350, that 100 basis point move, and we're at 285. But recently, in the last 5 or 6 years, we've only had a 50 basis point kind of high and low. So for us to go from 285 to 350 would be outside that norm. And in absolute yield levels, you've now backed up 35%. Because you're at such a low base to begin with, and I think that's what changes things.
Now, what about the corporate supply and the dynamics in that market?
Yeah, so I think the story this morning was about cash being brought back into the States by corporate America. That has to do with tax policy. There's also a change in the tax policy that means that when they issue debt, corporate America issues debt, how that debt will be treated on its balance sheet, and it will be negatively impacted this year as it might have been in the past. And then you have a European Central Bank and European investors, European Central Bank buying bonds out of Europe, so no bonds to buy. European investment managers needing bonds, buying U.S. bonds and buying corporate bonds. Well, if the European Central Bank is no longer going to buy back all of its Treasury bonds like the Fed was doing, well, then you would probably want to sell your corporate bonds in Europe. So you've got some supply kind of coming back into the market that I don't think anybody forecasted, just to suggest that corporate supply or spreads to the U.S. Treasury market are widening because of the negative economy. I don't think is the case right now.
All right, and to wrap it up, what's new with Nasdaq fixed income?
So full speed ahead on our new technology and new platform. We had a MarketSite event last week where we talked to a bunch of clients, and we're really out there giving our new spec to everyone to let them know in October, here we go. And then hopefully this afternoon, if I would say stay tuned around the fixed income space, we might start to talk about a futures contract as well.
All right, can't wait to cover that one. Well, thank you very much for joining me as always, and thank you. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.